Hey everyone, welcome back to Corporate Decoder today. We are diving into Eaton Corporation's latest filing, and let me tell you, it is packed with some significant financial moves. Get ready, because we are about to decode exactly what this means for the company and its investors. Before we jump in, if cracking open these corporate documents to find the real story is your jam, make sure you hit that subscribe button. We also have a community where we talk all things finance, linked in the description below, so come join the conversation. Alright, let's get straight into it. The main event here is about Eaton Corporation PLC, or Eaton Corporation as they are also referred to. They have filed a report on the 6th of February 2026, detailing some important agreements that have been put in place. So, what exactly happened? Well, back on the 29th of September 2025, Eaton had already set up a pretty substantial $3 billion revolving credit agreement. Think of this as a large credit line they can tap into when they need cash for their operations. This agreement involved the company itself, along with its subsidiaries like Eaton Corporation and Eaton Capital, and a bunch of banks led by Citibank. Now, on the 6th of February 2026, they decided to expand that credit line. They entered into what is called a commitment increase agreement. This means they've increased the total amount they can borrow under that revolving credit agreement from $3 billion all the way up to $4 billion. This is a pretty significant boost, showing they are either anticipating greater needs for cash or simply want more flexibility for future investments or operations. The good news is that this increase didn't change the original terms of the agreement, which is always a positive sign when you are dealing with financial arrangements. But that is not all. On the very same day, the 6th of February 2026, Eaton Corporation also inked another major deal, an $8 billion term credit agreement. This is a separate agreement that provides for a senior unsecured delayed draw term loan facility. This is a fancy way of saying they can borrow up to $8 billion. But it is not an instant thing. They have to follow specific steps, like giving notice and making sure certain conditions are met before they can actually draw down the money. This new $8 billion loan has a maturity date, meaning the date it all needs to be paid back, of the 31st of December 2026. So it is a relatively short-term loan. They'll need to repay it fairly quickly. It is also noted that they will pay a ticking fee. This fee is based on Eaton Corporation's credit rating from major agencies like S&P and Moody's. This basically means the better their creditworthiness, the lower this fee will be, or conversely, the riskier they appear, the more they'll pay in this fee. The agreement also comes with what are called customary negative covenants. In simple terms, these are restrictions on what the company and its subsidiaries can and cannot do. For example, they might be limited in taking on more debt or pledging their assets as collateral for other loans. These are standard clauses to protect the lenders. So, why is this all being reported? Well, these agreements represent direct financial obligations for Eaton Corporation. This means they are taking on significant debt and the market needs to know about it. The creation of these large credit facilities, especially the $8 billion term loan, is a big deal and directly impacts the company's financial structure. It is also worth noting the securities that are already registered for trading. We have their ordinary shares, which trade under the symbol ETN on the New York Stock Exchange. They also have two types of senior notes, the 4.450% senior notes due 2030, trading as ETN 30, and the 3.625% senior notes due 2035, trading as ETN 35. These are the existing ways the company has raised money and is being financed. These new credit agreements are in addition to these existing structures. The filing also includes the exhibits, which are essentially the actual legal documents for these agreements. Exhibit 10.1 is the commitment increase agreement, and Exhibit 10.2 is the term credit agreement. These are the official papers that lay out all the nitty-gritty details. Now, let's put on our analytical hats and look at what this all means. Eaton Corporation is a global power management company. They operate in diverse sectors, providing a wide range of products and services related to electrical, aerospace, hydraulics, and filtration. They are known for their innovation and their focus on making things more efficient and sustainable. Competitors include companies like Schneider Electric, Siemens, and Honeywell in various segments. So, about these massive credit lines, raising $3 billion initially, and then immediately increasing it to $4 billion under a revolving credit agreement suggests that Eaton is positioning itself for significant activity. This could be for acquisitions, major capital expenditures, or simply to bolster its liquidity cushion during uncertain economic times. The new $8 billion term credit agreement is even more telling. While it is a delayed draw, meaning they don't have to take the money all at once, the sheer amount indicates a strategic plan. Given the relatively short maturity of December 2026, it is unlikely to be for long-term slow burn projects. It could be to refinance existing debt that is coming due, to fund a large near-term acquisition, or to provide substantial operating capital. The fact that it is a senior unsecured facility means lenders are relying heavily on Eaton's overall financial strength and reputation rather than specific assets as collateral. The ticking fee structure is also interesting. It is a way for lenders to get some return even if the money isn't immediately drawn, and it directly ties their compensation to Eaton's perceived risk. A strong credit rating means a lower cost for Eaton, and a weaker one means a higher cost. What are the risks here? Taking on substantial new debt, even if unsecured, increases financial leverage. If Eaton's performance falters, servicing this debt could become a significant burden. There is always the risk that the company's plans for using this capital do not pan out as expected, leading to reduced profitability or even losses. However, Eaton has a long track record and operates in essential industries, which generally provides a degree of stability. In conclusion, Eaton Corporation is signaling significant strategic moves with these new, large credit facilities. The increase in their revolving credit and the addition of an $8 billion term loan show a company that is either preparing for major investments, managing its financial structure proactively, or both. While borrowing money is a standard business practice, the scale of these commitments warrants close attention to how Eaton will deploy this capital and how it will impact their future financial health. Alright, that is our breakdown of Eaton Corporation's latest filing. What is your take on these numbers and what they signal for the company's future? Do you think they are making smart moves or taking on too much risk? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into corporate finance. And remember to check out the Discord link in the description for more conversations like this. Thanks for watching, see you next time.